Welcome to the Booze Compass Q2 2026 Summary Analysis. Executive Summary. Q2 2026 marked a period of profound structural transformation for the global beverage alcohol industry, characterized by intensifying consolidation pressures, accelerating consumer moderation trends, and a decisive strategic pivot toward ready-to-drink cocktails and non-alcoholic alternatives. The quarter opened with the dramatic collapse of merger talks between Pernod Ricard and Brown-Forman, which would have created a $30 billion spirits powerhouse, followed by Brown-Forman's subsequent rejection of Sazerac's $15 billion acquisition bid, demonstrating that family governance considerations now outweigh pure financial optimization, even as traditional categories suffer sustained volume declines. Simultaneously, the three-tier distribution system underwent historic reshaping as Republic National Distributing Company divested operations across multiple markets to Columbia Distributing, Reyes Beverage Group, and other acquirers, fundamentally restructuring how products reach consumers. Financial distress cascaded through smaller producers throughout the quarter, with numerous craft breweries filing bankruptcy or closing permanently, including Kitos Brewing, Denton County Brewing, Penn Brewery, Zipline, Academia, Five Churches, and Bold City's downtown location, while RNDC announced over 1,000 layoffs in distribution operations. Market data revealed the severity of demand headwinds. U.S. beverage alcohol volumes fell 5% in 2025, according to IWSR. Super premium plus spirits categories declined 15%. Wine consumption extended a four-year slide to 15% below 2019 levels, and adult alcohol participation dropped from 67% in 2022 to just 54% in 2026. Yet aggregate performance masked significant category divergence, with spirits-based RTDs surging past $3.8 billion in off-premise sales, 16.4% growth, and non-alcoholic wine expanding 12.5% to 1.8 million cases, creating a bifurcated market where only innovation addressing convenience, moderation, and premiumization found traction. Major players responded with aggressive portfolio rationalization and strategic repositioning. Treasury Wine Estates slashed its brand count from 76 to approximately 30 while divesting California assets. Diageo cut dividends and announced restructuring. Brown-Forman paused Slane distillery production, and Sapporo sold Stone Brewing to Firestone Walker and Duvel Mortgott USA. Simultaneously, well-capitalized producers doubled down on infrastructure and growth categories. Anheuser-Busch expanded U.S. manufacturing investment to $600 million. E&J Gallo completed its $775 million acquisition of Four Roses Bourbon, and virtually every major spirits house launched RTD cocktail lines. The 2026 FIFA World Cup provided temporary on-premise relief, with beer sales rising 5.5% nationwide. But underlying structural challenges persisted, forcing the industry to confront a reality where growth depends not on expanding total alcohol consumption, but on capturing share within contracting categories and pioneering entirely new consumption occasions through zero-proof and functional beverage innovation. Key events. The quarter's most consequential corporate development was the April collapse of merger negotiations between Pernod Ricard and Brown-Forman, after weeks of intensive discussions around a proposed merger of equals valued at approximately $30 billion. The transaction fell apart amid competing interests, including Sazerac's concurrent $15 billion acquisition bid and irreconcilable differences over key terms, with Brown-Forman ultimately rejecting both offers despite compelling strategic logic. This double rejection signaled that family governance structures and ownership continuity concerns now trump financial optimization, even as market conditions deteriorate. The failed mega-merger did not slow broader M&A activity. Instead, consolidation continued through strategic bolt-on acquisitions, most notably E&J Gallo's $775 million purchase of Four Roses Bourbon from Kirin Holdings in April, Sazerac's equity stake in SIP Amards, and Mark Anthony Brand's acquisition of Finnish Long Drink. In a significant portfolio optimization move, Sapporo sold Stone Brewing to Firestone Walker and Duvel Mortgott USA, while Tilray divested Atwater, and Treasury Wine Estates announced plans to slash its brand portfolio from 76 to approximately 30, while simultaneously divesting California wineries and vineyards. The three-tier distribution system underwent historic restructuring as Republic National Distributing Company revealed plans in April to divest most of its business to multiple parties, with Columbia Distributing and Reyes Beverage Group emerging as key acquirers in the Pacific Northwest and beyond. By June, RNDC's footprint contraction accelerated, with its departure from Illinois coinciding with Reyes's aggressive market acquisition, while the company announced over 1,000 layoffs across distribution operations. This consolidation around fewer, larger distributors capable of managing complexity and capital requirements fundamentally altered supplier-distributor relationships and go-to-market strategies across the industry. Simultaneously, financial distress among smaller producers intensified throughout the quarter, with April seeing bankruptcy filings from Kitos Brewing, Denton County Brewing, Penn Brewery, and the Alton Distillery, followed by June closures of Zipline, Academia, Five Churches, and Bold City Brewery's downtown location. The Brewers Association reported craft beer production down 5.1% in 2025, with market share edging up only slightly from 13.2% to 13.3% because total beer sales fell even faster, a dynamic revealing that craft maintains relative position solely due to category-wide contraction rather than any inherent growth. Capital investment patterns revealed stark bifurcation between well-funded incumbents and struggling independents. Anheuser-Busch doubled its U.S. manufacturing investment to $600 million through its Brewing Futures initiative announced in April. Heaven Hill committed $200 million to new distillery capacity, and Robert Mondavi unveiled a 215,000 square foot renovation project, all demonstrating that scale and financial strength increasingly determine survival prospects. Financial performance data supported this divergence. AB InBev reported 5.8% revenue growth, explicitly crediting RTD portfolio strength and beyond beer innovation. Corby posted 21% revenue increases, while those lacking comparable RTD positions struggled. Marie Brizard down 9.6%, Diageo US Spirits down 15.4%, and Brown-Forman issuing flat revenue guidance while pausing Slane distillery production. Diageo's June dividend cut and restructuring announcements demonstrated that even category leaders face demand headwinds severe enough to trigger significant operational pullbacks. Product innovation activity concentrated overwhelmingly on two categories: ready-to-drink cocktails and non-alcoholic alternatives. The RTD category passed significant milestones, with spirits-based RTDs reaching $3.8 billion in off-premise sales, 16.4% growth, and 80 million cases in the U.S., prompting launches from Sazerac, 3 canned cocktail brands, Proximo, Cuervo RTDs, Hennessy, very special cocktails explicitly positioned for warm weather gatherings, Svedka, vodka water, and celebrity-backed brands from Mark Anthony, Dre, and Snoop. Projections showed the RTD category growing from $7.9 billion in 2024 to $15.8 billion by 2035 globally, with some forecasts reaching $13.7 billion by 2036, making it the consensus bet on future consumption patterns across virtually every major producer. Simultaneously, zero-proof innovation accelerated dramatically, with launches including Michelob Ultra Zero, Biro by Tom Holland, Campari's Crodino Push, Amass electrolyte mixers, Pizzolato non-alcoholic spritz, Owl's Brew functional mixers, Diageo-owned Ritual Zero-Proof RTDs, and MNG Brands' acquisition of Wellbeing Brewing, partly for THC-infused beverage development. Non-alcoholic wine grew 12.5% to 1.8 million cases, and non-alcoholic beer sales surged 23%, validating the strategic importance of these alternatives as adult alcohol participation dropped from 67% in 2022 to 54% in 2026. At the premium end, ultra-aged and limited edition spirits releases targeted affluent collectors willing to pay significant premiums for scarcity and authenticity. Notable launches included Jack Daniel's 14-year-old, Eagle Rare 30-year-old, Garrison Brothers 114 proof honey finished bourbon, Four Roses Mizunara cask finish, Blade & Bow's 12-year Solera Reserve, and Lost Lantern's United States of Bourbon. May 2026 whiskey auction data showed the top 20 bottles totaling $1.88 million, confirming sustained demand among high net worth enthusiasts, even as super premium plus spirits categories overall fell 15% in 2025. The 2026 FIFA World Cup provided temporary on-premise relief, driving beer sales up 5.5% nationwide and England pub bookings surging 293%, prompting experiential marketing investments including Anheuser-Busch's deployment of a 10-ton combine machine with beer taps for sports events. However, U.S. beer volumes still fell 5.3% over 12 weeks, and wine consumption remained 15% below 2019 levels, indicating event-driven spikes could not offset underlying structural moderation trends. Pattern recognition. The quarter revealed a decisive, industry-wide strategic pivot toward ready-to-drink cocktails as the primary growth vehicle, with virtually every major spirits producer, brewer, and wine company launching RTD line extensions or acquiring RTD capabilities. This wasn't merely product line expansion, but rather fundamental portfolio reorientation driven by documented consumer behavior. RTD cocktails represented the only reliably growing alcohol segment, while traditional formats contracted, adult participation rates plummeted, and health-conscious consumers demanded convenience, portion control, and occasion flexibility. The financial performance correlation was unmistakable. Companies posting revenue gains explicitly credited RTD strength. AB InBev's 5.8% growth, Corby's 21% increase, while those lacking RTD positions struggled. Marie Brizard down 9.6%, Diageo US Spirits down 15.4%. The scale and simultaneity of RTD investment, from Sazerac's 3 brands to Hennessy's very special cocktails to celebrity-backed launches, indicates producers view this category not as opportunistic but existential, representing the difference between maintaining distribution relevance and becoming marginalized as core consumption contracts. The projected trajectory from $7.9 billion in 2024 to $15.8 billion by 2035, and spirits-based RTDs already reaching $3.8 billion with 16.4% growth, validates this consensus, though market saturation risks loom as shelf space becomes increasingly contested. A parallel pattern emerged around aggressive portfolio rationalization and retreat to defensible premium positions as margin pressure intensified across traditional categories. Treasury Wine Estate's decision to slash brands from 76 to approximately 30 while divesting California assets, Brown-Forman pausing Slane distillery production, Diageo cutting dividends and restructuring, and Sapporo selling Stone Brewing all reflected a common strategic imperative: exit middle market positioning, consolidate around premium brands with pricing power, and reduce complexity as volumes decline. This rationalization occurred simultaneously with craft brewery closures accelerating throughout the quarter, from Penn Brewery and Kidos in April to Zipline, Academia, and Five Churches in June, creating a bifurcated landscape where scale, brand equity, and capital access increasingly determine survival while undercapitalized independents exit. The Brewers Association's data, showing craft production down 5.1%, yet market share barely maintaining at 13.3% because total beer fell faster, illustrates that even relative stability masks absolute volume destruction that smaller producers cannot withstand. The three-tier distribution consolidation through RNDC's divestiture to Columbia Distributing and Reyes Beverage Group, coupled with over 1,000 distribution layoffs, reinforced this dynamic by reducing the number of viable routes to market and favoring suppliers with scale and established relationships. The moderation and wellness movement transitioned from peripheral trend to core strategic consideration, evidenced by the explosion of non-alcoholic innovation and the stark adult participation decline from 67% to 54%. Non-alcoholic wine grew 12.5% to 1.8 million cases. Non-alcoholic beer surged 23%, and major producers launched zero-proof lines at unprecedented scale. Michelob Ultra Zero, Barrow by Tom Holland, Ritual Zero Proof RTDs, Campari's Crodino expansion, and MNG's Wellbeing Brewing acquisition. The timing and investment levels suggest incumbents now recognize these aren't niche line extensions, but essential hedges against structural consumption decline that IWSR forecast extending 6 more years globally. Yet the response remains somewhat tentative compared to continued traditional alcohol innovation, indicating established players still struggle to fully commit to cannibalizing their core businesses, even as younger legal drinking age consumers demonstrate preference for flexible, occasion-based consumption, including normalized zero-proof options. The hemp beverage regulatory uncertainty, entering a critical 6-month window, added another dimension to alternative format development, potentially enabling or restricting an entire category of functional beverages that producers like MNG explicitly pursued through acquisition strategy. International trade tensions and geopolitical fragmentation emerged as material headwinds beyond companies' direct control, with Canadian provincial boycotts causing American whiskey exports to fall 19%, $90 million decline, and U.S. Trade Representative Jameson Greer threatening retaliation. The Toasts Not Tariffs Coalition's formal Section 301 comments, arguing beverage alcohol's unsuitability for tariff remedies, reflected industry recognition that trade policy increasingly constrains global supply chains and market access. Simultaneously, regulatory divergence accelerated, Shanghai implementing strict alcohol warning labels, the EU providing 40 million euros for French winemakers to distill 1.2 million hectoliters of surplus wine into industrial ethanol at 33 euros per hectoliter. Tamil Nadu closing 717 state alcohol outlets near sensitive locations, and Thailand banning consumption in 8 public areas. This fragmentation creates operational complexity, requiring market-specific strategies rather than global standardization, disadvantaging smaller producers lacking resources for localized compliance while benefiting multinational corporations with regulatory affairs capabilities. The 2% global volume decline across 22 IWSR-tracked markets confirmed these were structural rather than cyclical challenges, requiring fundamental business model adaptation. Industry direction. Analysis of Q2 2026 developments indicates the beverage alcohol industry is entering a prolonged restructuring phase characterized by volume contraction, margin compression, and fundamental consumption pattern shifts that will likely persist through the remainder of the decade. The adult participation decline from 67% to 54%, combined with IWSR's projection of 6 additional years of global volume declines and documented category-specific contractions, beer down 5.3%, wine 15% below 2019, super premium plus spirits down 15%, suggests the industry faces not cyclical weakness, but permanent market shrinkage, requiring business model transformation rather than tactical adjustments. The bifurcated consumer response, simultaneous trading down to value formats, and selective premiumization for authentic experiential products, points toward hollowing out of middle market positioning that historically sustained many regional and mid-sized brands. Companies unable to command premium pricing through scarcity, craftsmanship, and compelling narratives, or deliver exceptional value through operational efficiency and scale economics, will likely face margin compression, market share loss, and potential exit through distressed M&A or closure. The accelerating craft brewery bankruptcies, Treasury Wine's brand count reduction from 76 to 30, and Brown-Forman's production pauses foreshadow broader rationalization as only the strongest brands and most efficient operators survive extended demand headwinds. The industry's strategic future appears increasingly concentrated around 3 defensive imperatives: dominance in ready-to-drink cocktails as the primary volume growth vehicle, development of credible non-alcoholic and low ABV portfolios to maintain distribution relevance as moderation accelerates, and premiumization of core alcohol brands to protect margins as volumes decline. The RTD category's trajectory from $7.9 billion to projected $15.8 billion, and spirits-based RTDs already reaching $3.8 billion with 16.4% growth, validates the first imperative: though saturation risks loom as virtually every producer floods the segment with new SKUs competing for limited shelf space. The second imperative, zero-proof credibility, remains incompletely addressed despite the surge of non-alcoholic launches, as most established producers still treat these as line extensions rather than standalone businesses with dedicated resources, potentially ceding this high-growth category to specialized disruptors unburdened by legacy alcohol infrastructure and channel conflicts. The third imperative, premiumization, faces execution challenges as demonstrated by the 15% super premium plus spirits decline, indicating consumers increasingly demand authentic differentiation and compelling value propositions to justify premium pricing rather than accepting aspirational branding alone. The whiskey auction market's $1.88 million for top 20 bottles and ultra-aged bourbon releases from Four Roses, Eagle Rare, and others suggests this strategy works for genuinely scarce, collectible products, but may not extend to broader portfolios. Longer-term structural implications suggest the industry will consolidate around fewer, larger, vertically integrated players with diversified portfolios spanning alcoholic and non-alcoholic formats, direct-to-consumer capabilities supplementing traditional three-tier distribution, and global scale enabling market-specific regulatory compliance and localized innovation. The three-tier systems transformation through RNDC's divestiture to Columbia Distributing and Reyes Beverage Group, coupled with over 1,000 distribution layoffs, indicates distribution will concentrate around fewer partners with greater negotiating leverage, forcing brand owners to either achieve sufficient scale to command distributor attention or develop alternative routes to market through e-commerce, direct shipping, and owned retail. International market fragmentation through trade barriers, Canadian boycotts, potential U.S. retaliatory tariffs, regulatory divergence, Shanghai warning labels, EU distillation subsidies, Thai consumption bans, and regional demand variations, emerging market resilience offsetting mature market weakness, suggests competitive advantage will accrue to multinational corporations capable of portfolio optimization across jurisdictions, rather than companies dependent on single markets or categories. The failed Pernod Ricard Brown-Forman merger and Brown-Forman's rejection of Sazerac's $15 billion bid demonstrate family governance can delay, but likely not prevent ultimate consolidation, as deteriorating market conditions will eventually force even resistant owners to consider strategic alternatives when operational performance no longer supports independent operations at competitive scale. Regulatory and policy. The regulatory environment in Q2 2026 featured significant developments at both state and federal levels, though international trade policy emerged as the most consequential area affecting industry economics. In April, Virginia enacted major liquor law reforms signed by Governor Abigail Spanberger, loosening the state's strict 45% food sales requirement for restaurants and doubling the spirits volume that approximately 45 Virginia distilleries can produce for direct shipping to consumers and ABC-licensed restaurants. Washington State's Liquor and Cannabis Board implemented expedited legislative changes affecting snack bar licenses, theater licenses, and cannabis producer fees while conducting compliance enforcement operations. California considered Assembly Bill 1585, a truth in labeling measure requiring wines labeled American to contain exclusively U.S.-grown grapes to protect local growers and improve transparency. International trade policy escalated into a critical industry concern as U.S. Trade Representative Jameson Greer threatened retaliation against Canada over provincial boycotts of American wine and spirits, with several Canadian provinces removing U.S.-made alcohol from stores following earlier trade disputes. American whiskey exports fell 19% in 2025, representing a $90 million decline attributed partly to Trump administration tariffs that prompted Canadian retaliation. The Toasts Not Tariffs Coalition, representing the U.S. beverage alcohol industry, submitted formal comments to USTR's Section 301 investigation into structural excess capacity, calling for exemption of wine and distilled spirits from potential tariffs and arguing that beverage alcohol's unique characteristics, High brand value, quality differentiation, and trade intensity make it unsuitable for tariff-based trade remedies that would ultimately harm American producers, distributors, and retailers while raising consumer prices. International regulatory developments included Shanghai's implementation of strict alcohol warning label trials across online and offline channels. The European Union providing 40 million euros to French winemakers to distill approximately 1.2 million hectoliters of unsold wine stocks into industrial ethanol at 33 euros per hectoliter as an emergency price stabilization measure. Tamil Nadu ordering closure of 717 state-run alcohol outlets, approximately 15% of total, within 500 meters of worship places, educational institutions, and transit terminals under new Chief Minister C. Joseph Vijay's drug-free initiative. And Thailand implementing bans on alcohol consumption in 8 designated public areas. A critical regulatory uncertainty emerged around hemp beverages as the industry entered a 6-month window, potentially leading to THC product restrictions, with regulatory discussions centered on product formulation limits, threatening the emerging hemp beverage category despite ongoing retail growth. This policy vacuum created significant business planning challenges for companies like M&G Brands, which acquired Wellbeing Brewing partly for THC-infused beverage development, and numerous craft producers exploring cannabinoid formulations as differentiation strategies. Overall, the quarter revealed continued state-level liberalization in the U.S. through expanded direct-to-consumer rights and licensing flexibility, escalating trade policy tensions internationally that threaten export markets, growing consumer protection measures in key overseas jurisdictions, and regulatory uncertainty in emerging categories like hemp beverages and non-alcoholic formulations, requiring ongoing industry engagement and scenario planning. Conclusion: Q2 2026 represented an inflection point where beverage alcohol industry leaders could no longer dismiss moderation trends, volume declines, and consumption pattern shifts as temporary disruptions requiring only tactical responses. The quarter's developments, from mega-merger collapses and portfolio rationalizations to unprecedented RTD and non-alcoholic innovation, alongside accelerating craft closures, collectively signal an industry confronting permanent demand destruction that necessitates fundamental business model transformation. Executives should recognize that future success depends not on reversing moderation trends or recapturing lost volumes, but on strategic repositioning around the growth pockets that remain: ready-to-drink convenience formats, non-alcoholic occasions, ultra-premium collectibles, and experiential consumption tied to major events and social gatherings. The companies posting financial gains in Q2 2026 shared common characteristics: diversified portfolios, including RTD strength, operational efficiency, enabling margin protection despite volume pressure, and capital access supporting infrastructure investment and strategic acquisitions, while those struggling lacked one or more of these attributes. Going forward, industry stakeholders should prioritize several critical imperatives: accelerating portfolio rationalization to exit unprofitable brands and focus resources on defensible premium positions or high-volume value plays; building or acquiring credible positions in RTD cocktails and non-alcoholic alternatives before distribution access becomes prohibitively competitive; developing direct-to-consumer capabilities that reduce dependence on consolidating 3-tier distribution; and preparing for extended volume declines by right-sizing production capacity, optimizing cost structures, and shifting performance metrics from volume growth to margin protection and share gain within contracting categories. The regulatory uncertainty around hemp beverages, intensifying trade tensions, and international market fragmentation add complexity requiring active policy engagement and scenario planning. The 2026 FIFA World Cup's temporary 5.5% on-premise boost demonstrated that experiential, event-driven marketing still generates consumption spikes, suggesting opportunities exist for brands that can credibly connect with cultural moments. But the underlying 54% adult participation rate and multi-year category declines indicate these tactical wins cannot substitute for strategic adaptation to a fundamentally changed consumption landscape, where alcohol competes not just with other alcohol categories, but with wellness priorities, functional beverages, and abstention itself.